The short iron condor option strategy is a neutral trading strategy that has the potential to profit when the stock price remains in a certain range as time passes. Now that means the stock price can trade sideways, upwards, or even downwards, and it can still profit. Now since the strategy can profit in such a wide stock price range, the short iron condor has a high probability of making money. Now, if the stock price increases or decreases significantly, then the short iron condor will actually lose money. Now, fortunately, the loss potential when selling iron condors is completely limited, which makes it a very conservative strategy. And with a high probability of making money and limited loss potential, the short iron condor is a great option strategy for income-driven traders who do not want to have to successfully predict the direction of the stock market. So how do you set up an iron condor? Well, the short iron condor is actually the combination of two popular option strategies, the first being the call credit spread. Now, a call credit spread is constructed by selling a call option and buying another call option at a higher strike price. So here's an example of what that might look like. Let's say we sold the 105 call for $2.50 and then purchased the 110 call for 50 cents. Now let's say when we do that, the initial stock price is $100. So with the stock price currently at $100, we've sold the 105 call and we've purchased the 110 call, and we put this position on for a net credit of $2. Now when selling call spreads, you want the stock price to stay below the strike price of the call option that was sold, which in this case is $105. Now if the stock price does trade below 105 through the expiration date of these call options, both of the options will expire worthless. Now since we sold the 105 call for $2.50 and we purchased the 110 call for 50 cents, that means we'd have a $250 profit on the 105 call and a $50 loss on the 110 call, which gives us a $200 profit on this call spread. Now the calls are worthless at expiration because a call option has the ability to buy shares of stock at the strike price of the option. Now if the stock price is below the call's strike price at expiration, there's no value in the ability to buy shares above the current stock price, which explains why the call options expire worthless. Now what if the stock price increases significantly? In this example, if the stock price was at or above $110 at the expiration date of these call options, the 105-110 call spread would be worth $5, which is the distance between the strike prices. But why is the call spread worth $5? Well, from the call spread buyer's perspective, the ability to buy 100 shares of stock at $105 a share with the 105 call and sell 100 shares of stock at $110 a share with the 110 call is worth $5 a share. So since we've sold the call spread for $2 and the call spread is worth $5 at expiration, that means we have a $300 loss per call spread that we've sold. Now the second strategy that makes up an iron condor is the put credit spread, which is when you sell a put option and buy another put option at a lower strike price. So let's say we sold the 95 put for $3.50 and then we purchased the 90 put for $2. That means we're going to collect $1.50 for this put spread. So just like we did before, let's go ahead and analyze what can go wrong and what can go right with this put spread. So let's say the initial stock price is at $100 when we sell the 95.90 put spread. So again, we've sold the 95 put for $3.50 and we've purchased the 90 put for $2. Now opposite of selling call spreads, when you sell a put spread, you want the stock price to remain above the strike price of the put that was sold, which is $95 in this example. If the stock price does remain above $95 through the expiration date of these put options, both of them will expire worthless, which means we'll have a $350 profit on the 95 put that we sold and a $200 loss on the 90 put that we purchased, which means our profit on this put spread is $150. But what if the stock price plummets? Well, in this case, let's say the stock price is below $90 at expiration. If the stock price is below the strike price of the put that was purchased, which is $90 in this example, the put spread will be worth the distance between the strike prices, which in this case is $5. Now since we sold the put spread for $1.50, if the put spread's value increases to $5, that means we'll have a loss of $350 per put spread that we've sold. So the short iron condor is simply the combination of the two strategies that we've just discussed. So you're selling a call spread and selling a put spread simultaneously. So let's go ahead and look at an example. Let's say with the stock price at $100, we sell the 105 call for $1.50 and buy the 110 call for 25 cents. We're also going to sell the 95 put for $2 and buy the 90 put for $1. That means we're going to collect $1.25 for the 105-110 call spread, and that also means we're going to collect $1 for the 95-90 put spread. So let's go ahead and take a look at how this position would perform in various scenarios given the stock price changes over time. So with the stock price at $100, we've sold the 105 call for $1.50, we've purchased the 110 call for 25 cents, we've sold the 95 put for $2, and we've purchased the 90 put for $1. So that means the total amount collected is $1.25 for the call spread and $1 for the put spread, which means we've collected a total amount of $2.25. Now, since we've collected $2.25 for this iron condor, our maximum profit potential is $225, which will be realized if the stock price is in between $95 and $105 at the time of expiration. In that scenario, all of these options will expire worthless, which means we'll have a $25 loss on the 110 call, a $150 profit on the 105 call, a $200 profit on the 95 put, and a $100 loss on the 90 put. Now that means we will have a $350 profit on the options we sold and a $125 loss on the options we purchased, which comes out to a $225 profit overall. Well, what would happen to this position if the stock price increased significantly to $115? Well, if the stock price is at $115 at expiration, the call spread would be worth $5, which is the width of the strikes, and the put spread would expire worthless. Now that means the iron condor's value would be $5 at expiration, and since we sold it for $2.25, the loss on the position would be $275. Now, if the stock price ended up falling significantly to $90 by expiration, then the call spread would expire worthless and the put spread would be worth $5, which is the width of the strikes, which would lead to the same overall loss of $275. So now that we've looked at some hypothetical short iron condor trades, let's go ahead and look at some real iron condor examples using historical option data to see how iron condors actually perform in real life. So the first example we're going to look at is a maximum profit iron condor that just happens to work out. So the initial stock price in this example is right around $575, and we're looking at options that expire in 46 days. So in this iron condor, we're going to sell the 615 call for $10.40. We're going to buy the 645 call for $4.47, which means we're going to sell the 615, 645 call spread for a total credit of $5.93. And we're also going to sell the 535 put for $11.75, and we're going to buy the 505 put for $6.03. And that gives us a total premium received of $5.72 for the put spread. Now that means overall we've collected $11.65 for this iron condor, which means our maximum profit is $1,165. Now the maximum loss potential for this particular iron condor is $1,835, and that's because the width of each spread is $30 and we collected $11.65, which means the most the position can move against us is $18.35. So let's go ahead and see what happened with this particular iron condor position as the stock price changed over time. So on the top half of this chart, we're looking at the changes in the stock price over time relative to the strike prices of this iron condor. And in the bottom half of the chart, we're actually looking at the price changes of the iron condor as the stock price is changing. So the first part about this trade that I want to talk about is the immediate collapse in the stock price after selling the iron condor. Now, as we can see, the stock price fell significantly, which resulted in an increase in the value of the iron condor. And when the iron condor's value is higher than the initial sale price of $11.65, the position is unprofitable. Now the second notable thing to talk about with this trade is that at point number 2 here, we can see that the stock price is unchanged from the point of entry, but we've had about 30 days pass. And as we can see here, with the stock price unchanged relative to where we initially sold that iron condor, the iron condor is only worth $4 now as opposed to $11.65. And with the iron condor at $4 and an initial sale price of $11.65, the current profit at that point would be $765 per iron condor sold. Now the last thing I want to talk about is at expiration. Now as we can see here, the stock price is in between the put spread and the call spread at expiration, which means all of the options in this iron condor are worthless. Now, that essentially means that the iron condor itself expires worthless, and since it was sold for $11.65, that means the profit at expiration would be $1,165 per iron condor. Now, in this next example, we're going to look at an iron condor trade that does not go as planned. So in this case, the initial stock price is $121.45, and again, we're going to be looking at options with 46 days to go. So to start off our iron condor, we're going to sell the 124 call for $1.05. We're going to buy the 128 call for 38 cents. And that means for this 124-128 call spread, we're going to collect 67 cents. Now we're also going to sell the 119 put for $1.25 and also purchase the 115 put for 39 cents. Now that means the 119-115 put spread we're selling is going to collect 86 cents. Now by selling the put spread and call spread simultaneously, we're collecting a total of $1.53 in option premium, which gives us a maximum profit potential of $153 per iron condor. Now since the call spread is $4 wide and the put spread is also $4 wide, that means the most this iron condor position can be worth at expiration is $4, which means our maximum loss potential on this position is $247. Since we collected $1.53 and the most the iron condor can increase to is $4. So let's go ahead and take a look and see what happened with this iron condor position. So again, on the top part of this chart, we're looking at the changes in the stock price relative to the iron condor components, and in the bottom half of the chart, we're looking at the iron condor's price changes as the stock price is changing over time. Now as we can see here, the stock price increased over the entire period and blew through the call spread portion of the iron condor position, which resulted in losses for the trade overall. Now since the stock price was above the entire call spread at expiration, the call spread is worth $4 and the put spread expires worthless, and that means the iron condor as a whole is worth $4. Now since the iron condor's value is $4 at expiration, that means the loss on this position is $247 per iron condor sold because the position was initially sold for $1.53 but increased to a value of $4. So now that you understand the basic concepts of selling iron condors, how do you actually sell an iron condor using real brokerage software? So for this demonstration, we're going to use the Tastyworks brokerage platform, and if you want to actually get one of our options trading courses for free, there is a link in the description that will tell you exactly how you can do that when you open an account with Tastyworks if you haven't already. So let's go ahead and hop over to the trading platform. Okay, so right now I'm in the Tastyworks trading platform, and I currently have up a chart of Facebook. Now as we can see here, Facebook has been chopping around quite a bit over the past few months, and since July of 2017, the stock has been between $200 and $150 at the low point, and it's currently trading around $185. But as we can see here, there's been a lot of sideways chops, so to speak, and if we believe that this price action would continue into the future, then that would make Facebook a good candidate for a short iron condor position, because the short iron condor, as we've learned, profits when the stock price remains within a certain range of our choosing. So how do we go about actually selling an iron condor on Facebook, and how might we go about choosing the strike prices and the expiration date of the options? Well, I know a lot of people use technical analysis in their trading, and they might look at this recent high in Facebook of around $195, and since there was such a strong decline from that price point, a trader might think that that would continue into the future. So when you go about selling your call spread portion of the iron condor, maybe you choose a short call with a strike price around $195, or maybe you give it some room and go up to the 200 strike price. Now on the downside, we probably won't be able to go all the way down to $150 because that is significantly lower than the stock price, and we probably won't collect any premium for selling that put option. So we'll probably have to come up to probably 170 or 175. So to set up an iron condor position, we're going to need to sell a call spread, and then we're also need to sell a put spread below the current stock price. So the strikes I'm going to look for are using a short call of 195 or 200, and then I'll have to buy a call at a higher strike price than that. And then for the put spread, I'm probably going to target a short put of 170, and I'm going to have to buy a put below that. So to get to the trade page on the Tastyworks trading platform, all you have to do is click on the trade button on this left-hand menu over here. So I'm going to click trade, and that's going to bring me to the expiration cycles for Facebook. So I'm going to use the 60-day expiration cycle, which is July of 2018. And all I need to do is click there, and that will drop down the option chain for July of 2018. And on the left-hand side here, we can see the call prices and strike prices, and we can also see the put prices on the right-hand side. So to create our iron condor position that we were discussing when we were looking at the chart page, I'm going to have to sell a call and then purchase a call at a higher strike price, and then sell a put and buy another put at a lower strike price to complete our iron condor position. So I mentioned I was going to target the 195 or 200 call to sell. So I'm going to go ahead and look at selling the 200 call, and then I'm going to go ahead and buy the 205 call, and that's going to create a 200-205 call credit spread, which is currently trading for 61 cents. So on the put side, I mentioned I was going to target a 170 put to sell. So I'm going to go ahead and click on the bid on the 170 put, and then I'm going to also use a 5-point put spread. So I'm going to buy a put option that is 5 points lower than the put I've sold, which is the 165 put. So to buy the 165 put, I'm going to click on the asking price of the 165 put, and now I have my iron condor set up, but it is not yet routed. So I haven't made any trades yet. I'm just setting up the trade that I want to potentially put on. Now, one of the cool things about the Tastyworks trading platform is that when you queue up a trade that you're potentially going to put on, it gives you a number of trade metrics on the bottom portion of the screen related to that position. So this trade info row right here is giving us metrics related to this iron condor that I've just set up. So POP stands for probability of profit, which is estimating the probability that we have a profit of at least 1 penny on this trade if we were to hold it through expiration. So it's estimating that our probability of profit is 64 to 65% when we sell this iron condor, which means that there's an estimated 65% chance that we have a profit on this trade if we hold it through expiration in 60 days. Now EXT says 122, and as we can see here, the price of this iron condor is $1.22, which in actual premium is $122 since standard equity options control 100 shares of stock. So we just have to multiply this by 100 and we get 122. And this is telling us that there's $122 of extrinsic value in this trade right now. So basically that means if the stock price were right where it is at expiration, we would collect $123 of extrinsic value, which basically means we would profit by $123, which means that this iron condor would expire worthless. So this P50 right here is the probability of making a 50% profit on this trade. So since this iron condor is trading for right around $1.20, a 50% profit would be reached if the iron condor's price fell by 50% to around 60 cents. So this P50 is estimating that our probability of reaching a 60-cent profit on this trade is right around 78%. Now the delta is wrapped right around 0, which basically tells us that this position is directionally neutral. So if the stock price increases or decreases by $1, we're not expected to make or lose basically any money, which means a small change in the stock price should not change our position's profitability. Now theta is positive 1.62, which basically means that with the passage of 1 day, we're expected to make $1.6 in profits. So the max profit of this position is the current price of the iron condor, which is $123 in actual extrinsic value, and that can be seen by looking at the mid price of this trade right here. So the max profit of any position is going to be, well, for an iron condor, it's going to be the credit that you receive times 100 times the number of contracts. And since we're only looking at one iron condor here, and if we sell it for $1.23, our maximum profit potential is $123. And lastly, the maximum loss potential of this position is right around $380, and that's being calculated by taking the width of the widest spread, which in this case is actually $5 on both sides. So since both spreads are $5 wide and we're collecting $1.21 for this, if we take $5 minus $1.21, we get $3.79, which if we multiply by 100 is a loss of $379. So this is telling us that if we sell the iron condor for $1.21 and the iron condor's value increases to $5 by expiration, the loss on that position would be $379 per iron condor that we sell. Now, if we actually wanted to visualize the profit potential and the loss potential of this position, all you have to do is click on this analysis button right up here underneath the Facebook metrics. So it says trade mode right here, and all you have to do is click analysis, and then we have to also go to the curve, and this will show us the profit and loss potential of this position through expiration. So right now we're actually looking at the expiration profit and loss graph of Facebook, and if we hover over any price, it gives us a P&L Theo under that box that's highlighted on the top, and P&L Theo is the theoretical P&L at that Facebook price given all the conditions today. So if price was the only thing to change today, that would be our estimated profit or loss. So as we can see here, if Facebook fell to, let's say, $158 today, it's estimated that we would lose about $247. So at expiration, you can see the P&L exp says 121 at any price between our short call and short put. So anywhere between $170 and $200, the expiration profit would be $121 for this iron condor, since we'd be selling it for $1.21. Now, if we go to any price below the long put of 165 or above the long call of 205, we can see the P&L exp says $379 loss. So at any price above $205 or any price below $165, our loss at expiration would be $379, and that's because at any price below 165 or above 205, one of these spreads would be worth $5, while the other one would expire worthless, and that means that our iron condor would be worth $5, and since we sold it for $1.21, our loss would be $379 per iron condor. So if we actually wanted to sell this iron condor and put it on in our brokerage account, we would go to the bottom right hand corner to this review and send button and click review and send. Now this is going to bring up a panel that has information about our trade that we can double check just to make sure we're not making any mistakes related to the position. So this is telling us we're trying to trade one Facebook iron condor, and we're trying to sell the 170 put, purchase the 165 put, sell the 200 call, and buy the 205 call in the July expiration cycle with about 60 days to go. So you can see it says sell, sell, and buy. So we're basically selling the 170 put and the 200 call, and we're also trying to purchase the 165 put and the 205 call. Now this is saying the net credit is $1.23, which is the mid price of this iron condor position as of hitting that review and send button. The commissions are also estimated here for us as well, and it's estimating our commissions to be $4, which makes sense since as of this recording, the commissions for Tastyworks are $1 per option contract, and since we have 4 option contracts in this trade, we have $4 in commissions, in addition to some small fees that are exchange related. So this is estimating that our total commissions are $4.58, and the estimated buying power effect underneath that is going to tell us how much this is going to reduce our available buying power by if we route this trade. So it's saying that it's going to reduce our buying power by $381.58, which is just the maximum loss potential of this trade in addition to the commissions and estimated fees. So $377 plus $458 gives us $381.58. Now if we actually wanted to put this trade on and everything looked good to us, all we'd have to do is hit this big orange send order button, and if the trade got filled, then we would successfully have sold this iron condor in Facebook. If you enjoyed this video, be sure to check out some of our other options trading videos featured on this page right now. I hope you learned something about selling iron condors in this video, and if you enjoyed it, please give the video a like and leave a comment down below. Once again, I'm Chris from Project Option, and thank you for watching.